Hey everyone, welcome in to another daily editorial here on the KE Report. I'm talking commodities that I am now chatting with Darrell Fletcher, Managing Director of Commodities at Bannockburn Capital Markets. Darrell has just started up the commodities trading desk over at Bannockburn, so I always find it interesting to get his take on what he's seeing in the commodity sector from that trading desk aspect. We'll talk crude, some of the products behind crude. We'll also touch on copper again. And I'm going to ask Darrell a little bit about precious metals that continue to, in a way, almost lead investor interest in the resource sector. So, Darrell, first and foremost, you sent out a crude and product summary recently to your customers. You forwarded that to me. It breaks down what you're seeing in the crude market as well as into the fuel market. Give us kind of the macro lay of the land here first.
Sure, yeah. I mean, big picture, thanks, Corey. On the macro side, if you look at the GFCI or crude, we basically bottomed out 2 weeks ago, hit 3-year lows, and that bleeds into the fuel markets being very like good entry points for the consumer side. So I did a little bit of work on that, but we've had a bounce in the past about week and a half or two. Crude bounced off that 3-year low. It was at 65.75 back on Sep 10, I think, right around there. Now it's bounced back up over that long-term 70-90 thing I always look at. We're back up over 70, but just barely here. But macro, I mean, we hit some pretty, deep low numbers across the commodity sectors on the whole. And we've had a little bit of a bounce here in the past 2 or 3 weeks. Some of that, no, a good chunk of that probably was on the 50 basis point cut by the Fed. And when those things happen, like all things being equal, I really look at okay, what did crude do, what did copper do, what did gold do? Because those are your real macro type commodities, assuming there wasn't a big inventory change or a hurricane or something that would affect on the energy side. And they all rallied pretty nicely. And obviously, gold continues to set highs, seems like every day recently. But that's kind of the big macro picture. Like I said, crude bottomed out about 2 weeks ago almost at 65.75 WTI basis. I had a nice bounce here back up late last week or two. We're just back up over 70. There's really three things kind of driving the weak global outlook on crude. And I don't know that they've necessarily changed, but the things that are really in focus, and we talked about this last time, I think, were the OPEC cuts, the unwinding of those cuts here in fourth quarter. Now, that did get pushed to December already, but I still think that's highly anticipated in keeping a cap on pricing. Kind of the loose enforcements of sanctions in Iran and Venezuela would be number two. And then three, the assumption that we're going to have non-OPEC type growth come into the supply chain in the next year. So it looks like there's going to be a balance, a positive balance on supply and demand in first quarter 25. So that's kind of why we've seen this push to the low end. But there are bullish factors out there too, still, and I think even to some extent, the geopolitics are a little bit undervalued right now. We saw that over the weekend. I was surprised crude didn't open higher today, and it did not. It's actually off about 50 cents. And I do know global crude stocks, especially DOE in the US, those inventories are running pretty low. So you've got some offsetting factors. Overall, I'm kind of neutralish on crude, but I think that this 70's really been an anchor here. So it's going to be hard, I think, to really move too far away from it to the downside.
Crude still very much has just been in kind of this range though, right? It's a wide range, but even that break to 65, yes, it was a 52-week low, but it was May of last year, 2023, when crude was down at $63. So again, if it doesn't break that lower level, sounds like you're even seeing kind of that mixed picture of more range bound pricing.
Yeah, it's funny. Those breaks down below don't last very long. And so I still kind of stay focused on the 70 to 90 range, which has been in play for a while, except with these couple breaks down below it, but they don't last. So, maybe 70 is your new anchor and there's just kind of offsetting factors. So pretty neutral here. Right. Now that what it has done though is interesting is it's highly correlated on the fuel side. So that's where I've been doing a little bit of work, both diesel and gasoline, at least US basis. They hit 3-year lows also, but intriguingly, the forwards in 25 and 26 hit 2-year lows, and the curve really flattened out. And that's very rare because if you hit this big move down in the front, typically, like actually like most commodities, if you have a big move down in the front, it's due to some kind of supply oversupply in the front, or to the high side if it's a natural cause issue affecting supply. But this front has moved down, and then you flattened out the curves to basically diesel fuel is 215 to 220 all the way through 27, Cal 27, and gasoline's down below 2, and you even go into backwardation into 27. Not a lot, but it's basically a flat curve going out. So that's it. Typically is actually right now looking like it's kind of following that. Crude curves has done the same thing. So there's been great opportunities, at least in my opinion, on the consumption side of really good entry points into these fuel markets for hedgers. On the consumption side, we haven't been here since late 21, kind of the tail end of the pandemic, the growth.
So, Darrell, one thing you outline in that report is risk to the upside. It's what you've been kind of dancing around here is that you say fundamentals are certainly not bullish. The market is pricing in the most bearish scenarios for supply growth. That deals with OPEC, the U.S. supply, other non-OPEC supply growth. All of this also then needs to be carried over to demand, which look, economies in the US seem to be doing okay around the world. We do have a lot of risks and people still pointing for a recession. But when you see, it seems like everything pointing in more the bearish side of things, do you get enticed or do any of your clients get enticed to take that contrary bet?
Yeah, they do. And that's why I've spent some time on this. Those bearish factors, you have to assume that they all hold. Like those are the things, to your point, it's kind of bracing in, okay, all these things are pointing lower. But those wild cards is just commodities. They never leave. And they're always out there. Things can change on a dime. So when you're looking at value from a fuel consumption perspective, these are great points. I mean, historically, these are really good points. They don't come around very often, and typically you don't. If you do get it, you don't get this forward curve that's flat out 2, 3 years. So yeah, we have seen interest both in fixed price swaps and collars.
Interesting. Let's also talk about copper then, because copper, as you noted, bounced and moved higher on the back of that rate cut, but it also managed to hold right around that $4 level and is now a fair bit higher than that. It's not breaking out to the upside, but at least it held that $4 level. What interest have you seen in the copper side of things from hedgers or general investors?
Yeah, it's had a nice move to your point. We've had that bounce from the 4 level up to about 430 here almost today. And that's been the past couple of weeks. Two things there. One, the Fed rate cut is we had mentioned earlier as from a macro basis. You always look at copper, oil, and gold. But also copper stocks have finally, global copper stocks, LME, Shanghai, COMEX, that balance has finally turned down. We're back to like June levels because you've had a steady supply increase on the global stocks across those three houses all year until just recently. We kind of turned back down towards the June level. So I think that's giving some hope that we kind of bottomed out here at 4. And 4 clearly held, that's for sure. It held once back in early August, a couple times in September here.
Do you see more investors coming into the copper space? Is there that maybe new investor that sees the need for copper for data AI center build outs, any of the electrification narrative that has brought in, again, newer investors?
Yeah, I mean, that's going to be there on the consumption side for sure. I think speculatively, copper's always kind of in sync with gold and in those moves. So yeah, I think so. And I think there's just a general underpinning right now, given where the infrastructure should be going. And it's just a matter of time if it does start to. But this move down in global stocks is pretty positive.
How do you play that? Why is there that move down in global stocks then?
Well, I think some of it is at least there's some inventory restocking in China that's been happening. A lot of that move down has been on the Shanghai stock balance. And so there's hope that China's starting to their copper buys back on. You don't really see it in implied crude imports though. So that's everyone always looks at copper or China to see, hey, what is going to be happening in copper.
there anywhere else in the world, other countries that you see as not taking over for China, but being another or the next beacon of growth, possibly?
Well, yeah, infrastructure globally. I mean, if you look at infrastructure global, U.S., advanced economies, not advanced economies, it's going to be needed across the board in infrastructure growth.
Okay, so that's the big growth for copper then. Does that mean copper could get up to double digit per pound pricing, or is that just a little too extreme in your eyes from a trading desk perspective?
Well, I think, yeah, that's a little too extreme in any time in the near future. That move up to five was back in May was a big one, and clearly it's kind of balanced itself back to four here.
Yeah, that all happened so
Yeah, it's just
quickly.
going to take time.
Yep, fair enough. And now, what about gold or even silver? Silver is a much smaller market, so I assume it's not nearly as active for you on a trading desk. And gold, look, like a lot of these companies I think that you deal with need to hedge their exposure because they use these different types of commodities. Gold is one of these where it's dug out of the ground and saved in terms of a wealth preserver, many different reasons, but it's not always used. So companies don't need that sort of hedged exposure to it. What do you do in the precious metals space?
Yeah, gold, that's really just basically a macro indicator. And we were talking about this earlier. It's been impressive. Gold and silver both up around 35% in the 1 year. The opposite end of that's iron ore, which is down about 25%. So those are kind of your brackets in the commodity space this year so far, not including like lithium or cobalt. But yeah, so that's more of a macro indicator. Silver now, the silver does have some industrial applications, whether it's in antennas and windows, things like that, in solar panels, things like that. So there's a little more use case on the silver side, kind of more along the lines of a platinum or palladium. But it's been impressive. And gold's move is pretty much every day right now, hitting new highs. So I would expect to see some retrenching on that at some point, just for some to take a breather. But it certainly has been impressive.
Hey, gold's been almost a momentum trade as well with how quickly and easily it has seemed to move higher. What have you noticed in terms of investors, though? Are there more investors looking at the gold space? We've seen a little bit more interest in the Western investor, it seems like, but what's your assessment of that market?
Yeah, there's if you look at some of the speculative positions, the gold position seems to be gaining on the spec side, and there's been some unwinding on the crude side, although it looks like it's slowed down a little bit. So we don't have a lot of industrial type users to your point, but so we kind of watch the speculative side of it and where positioning is taking place.
So broadly, taking a step back, you run a trading desk. Again, focus commodity wise. When we hear about commodities, we keep hearing about how resources have just decreased in value when you compare it to what the broader markets have done. Financial assets compared to hard assets, or just even compared to commodities. Is there a change that could be happening? Could commodities come more on the radar for your average investor?
You would hope so. I mean, we were talking about this earlier, you and I, and it's interesting, especially looking at gold and silver. I mean, from just a free cash flow perspective, a lot of these resource companies do really well, and it's not exciting, but a lot of these companies, whether it be copper, oil and gas production, they free cash flow well, and they've been in the oil and gas space historically, relatively speaking, they're being a lot more disciplined. So you would hope so. You would hope that some of these companies finally get interest and get essentially paid for their free cash flow and some discipline.
You would think so, but what has happened in the past then? What have you seen in the past when we have been in these commodity cycles and commodities have run for a decade?
Well, yeah, I mean, in terms of things running higher, it's just when they get undisciplined, I think more on the oil and gas side when they become undisciplined and they're getting paid just to grow. And I think that's been reined in quite a bit, which is fundamentally a better thing for these companies. So maybe it's just going to take time, Corey, for from the investment side to start turning more over to the commodity side and the resource side. Given that these companies, assuming they hold their discipline around these things, and finally they can see some of the returns on what they've done.
So just time. Could just take time, keep building up those balance sheets, keep building up the overall financial health of the companies, and yeah, see if the investors do manage to come in. But overall, hey, these commodities are still doing decently. It is just being led mostly by, it seems like, the precious metals, especially gold right now. Darrell, great having you on. Again, Darrell Fletcher, Managing Director of Commodities over at Bannockburn Capital Markets. We'll chat again next month. Darrell, thanks for your time today.
All right, Corey.